Jason and Karen are both 43 years old. Together they earn $150,000 a year. They have $45,000 in workplace retirement accounts, $12,000 in cash, $14,400 on a credit card at 22.49%, and 24 years until the age 67 retirement marker. Their problem is not that Jason chose the wrong person. It is not that Karen spends and Jason saves. It is not that one person is responsible and the other person is broken. Their problem is a household in which two incomes share obligations, but the paychecks, bills, balances, decisions, and future goals have no common operating system. I call the cost of that missing system the household coordination tax. It is not a government levy. It is a metaphor for the money and time lost when shared obligations have no shared routing map, decision rule, or future first assignment. For Jason and Karen, it has three mechanisms: the routing collision, the threshold fog, and the future last default. By the end of this video, those mechanisms will become one money map, one decision protocol, and one automatic route from high-interest debt toward retirement. Every number in this story is a fictional educational illustration. It is not a forecast, a guarantee, relationship advice, legal advice, tax advice, or individualized financial advice. Jason is a facilities supervisor in Columbus, Ohio. His modeled gross pay is $82,000 a year. Karen is a medical billing specialist. Her modeled gross pay is $68,000 a year. Combined gross pay is $150,000. Their modeled combined take-home is $8,400 per month after current payroll deductions, benefits, taxes, and existing workplace plan contributions. Actual take-home depends on filing status, benefits, location, and plan elections. Their monthly household commitments total $7,400. That number includes a scheduled $360 card payment. The difference is $1,000 of reliable monthly margin. They have $12,000 in cash, $45,000 combined in workplace retirement accounts, and $14,400 on the card at 22.49%. Their current combined retirement inflow is $750 per month, including fictional employer contributions only after the actual plan terms are satisfied. Cash plus retirement minus the card creates a simplified tracked financial position of $42,600. That is not complete household net worth. A home, vehicle, other debts, taxes, family support, ownership rules, and legal obligations remain outside this illustration. The first mechanism is the routing collision. Jason gets paid every other Friday. Karen gets paid twice a month. Their mortgage leaves one account. Utilities leave another. Insurance charges a card. Subscriptions renew across 3 dates. Retirement contributions leave before take-home arrives. Separate accounts are not the problem. Joint accounts are not automatically the solution. The collision happens because no one page shows when income arrives, what leaves, which balance carries interest, which transfer is automatic, and who owns the next action. Jason sees enough money on payday and schedules a repair. Karen sees the insurance draft and moves cash to protect the mortgage. Neither decision is irrational. Both people are acting on incomplete views of the same household. 3 days later, an automatic charge lands on the card. The household coordination tax did not come from a bad partner. It came from 2 accurate partial maps that never became one complete map. The Consumer Financial Protection Bureau describes a bill calendar as a way to track what is owed and when it is due. Its cash flow tools place income and expense timing on one view. Jason and Karen build a shared money map. They do not merge every account. They do not surrender personal autonomy. They list every income date, bill, due date, minimum payment, automatic charge, balance, annual percentage rate, cash reserve, workplace contribution, and employer term. Beside every line, they add an owner and a next review date. The mortgage can stay in Jason's account. Insurance can stay in Karen's. The card can remain where it is. The map connects the information without requiring one universal account structure. That distinction matters. Peer-reviewed research has found associations between financial account pooling and financial communication in studied samples. Other research has linked full pooling with greater relationship satisfaction in the couples studied. That evidence does not prove every couple should merge money, safety, coercion, legal exposure, previous obligations, business ownership, autonomy, and personal preference can make a different structure necessary. The useful lesson is narrower. Shared decisions need shared visibility, whatever account structure the household chooses. The shared money map blocks the routing collision. The second mechanism is the threshold fog. Without a decision rule, Every unplanned purchase becomes a new negotiation. $40 for a school event may be urgent. $180 for a household tool may be useful but not urgent. $600 for a weekend trip may matter deeply to both people and still require a different review. The numbers do not contain moral answers. The missing categories create the friction. Jason and Karen choose a personal threshold of $150 for non-urgent, unplanned purchases. The threshold is not universal. It is not permission to monitor or control each other. Below the threshold, each person uses the personal spending lane already assigned on the map. At or above $150, the item waits for the next 30-minute weekly review. They record 4 things: amount, purpose, deadline, and which household goal changes if they say yes. Medical needs, safety issues, essential household needs, dependent needs, and true work emergencies bypass the delay. If a financial conversation involves fear, coercion, hidden control, or personal safety, a shared spreadsheet is not the solution. Appropriate legal, advocacy, counseling, or safety support may be necessary. The weekly review is not a courtroom. Jason does not prosecute Karen's coffee. Karen does not audit Jason's tools. They review decisions that cross the rule both people selected. The protocol changes the question from who is wrong to which lane does this decision use. 1 week, the answer is yes. Another week, the answer is wait until the insurance draft clears. A third answer is yes, but reduce a different flexible category. The system permits enjoyment. It also shows the trade-off before the money moves. The decision protocol blocks the threshold fog. The third mechanism is the future last default. The credit card does not wait for alignment. At a constant starting balance, a simple monthly interest scale is $14,400 multiplied by 22.49%, divided by 12. The result is $269.88. That is not a statement prediction. The Consumer Financial Protection Bureau explains that many issuers calculate interest daily using a daily periodic rate and daily or average daily balances. New charges, fees, payment timing, different balance categories, and issuer methods change the result. The simple scale shows pressure. The statement supplies the actual charge. Jason and Karen open the current statement together. They also open the CFPB debt action plan and Investor.gov guidance on high-interest debt. Then they choose a fictional route for this illustration. From $12,000 in cash, they keep a personal $6,000 starter reserve. The reserve is not universal. Household income stability, dependence, health, housing, insurance, job risk, and other obligations can require a different amount. They apply $6,000 to the card. The balance falls from $14,400 to $8,400. They assign $700 of the $1,000 reliable margin to the card and keep $300 as operating margin. The scheduled $360 plus the additional $700 creates a modeled payment of $1,060 per month. The debt model uses 4 fixed assumptions: no new charges, constant 22.49% annual percentage rate, monthly compounding, and month-end payments. Real cards may accrue interest daily. Actual statements will differ. Under the model, first month interest after the cash payment is $157.43. The card reaches 0 in month 9. The final modeled payment is approximately $700.51. Total modeled interest after the cash payment is approximately $780.51. A new charge, fee, rate change, missed payment, or emergency changes the date. Now return to the tracked position. Before the cash payment, $12,000 cash plus $45,000 retirement minus $14,400 card debt equals $42,600. Immediately after the cash payment, $6,000 cash plus $45,000 retirement minus $8,400 debt still equals $42,600. Moving cash to debt does not create wealth at the moment of transfer. At modeled payoff, hold retirement and cash constant and exclude new contributions and returns. $6,000 cash plus $45,000 retirement minus 0 card balance equals $51,000. The $8,400 improvement equals card principal removed by monthly cash flow. It is not investment return. The future last default usually returns after payoff. A payment disappears, and lifestyle silently absorbs it. Jason and Karen assign the released money before the balance reaches 0. $700 per month routes toward retirement. The former $360 scheduled payment routes toward reserve rebuilding. $300 remains operating margin. Their existing retirement inflow is $750 per month. After the plan increase, the model total becomes $1,450 per month. Before changing payroll elections, they open both workplace plan documents. The United States Department of Labor explains that defined contribution outcomes depend on contributions, investment performance, and fees. Employer matching and vesting depend on actual plan terms. Jason and Karen confirm contribution formulas, vesting, investment options, fees, current limits, tax treatment, and the real paycheck effect. Then there run two illustrations. For a clean comparison beginning at age 44, both paths start with $45,000, use 23 years to age 67, and compound monthly. This intentional excludes first-year contributions and returns. It is a scale comparison, not a forecast. At $750 per month, the 5% illustration reaches approximately $528,898. At 7%, it reaches approximately $735,721. At $1,450 per month, the 5% illustration reaches approximately $890,208. At 7%, it reaches approximately $1,213,257. The model difference from the added $700 per month is approximately $361,310 at 5% and approximately $477,536 at 7%. Those differences are not guaranteed gains. They assume uninterrupted contributions, fixed modeled returns, and monthly compounding. Markets fluctuate. Fees and taxes reduce outcomes. Account rules and household facts change. Investor.gov's compound interest calculator asks for an initial investment, monthly contribution, time, estimated rate, and compounding frequency. Estimated is the word that protects the model from becoming a promise. The Social Security Administration says full retirement age is 67 for people born in 1960 or later under current law. For Jason and Karen, age 67 is a planning marker. It is not a required work stop date, a claiming instruction, or proof that these balances are adequate. The future first route blocks the future last default. Now the relationship is not the tax. Jason is not the tax. Karen is not the tax. The tax was a household system where information was partial. Every decision needed a fresh negotiation. Debt interest moved automatically, and retirement waited for leftovers. Pressure became analysis. Analysis became three blockers. The shared money map gives both people the same verified view. The decision protocol gives non-urgent choices a threshold, a review window, and essential exceptions. The future first route gives the card payment and the released cash flow a destination before the month can claim them. If you are between 38 and 52 and share financial obligations with another person, build 3 files this week. File 1, Shared Money Map. List income dates, bills, due dates, automatic charges, balances, annual percentage rates, cash, workplace contributions, employer terms, owners, and review dates. File 2, Decision Protocol. Choose a personal threshold, a weekly review window, 4 decision inputs, and explicit medical, safety, essential, dependent, and work emergency exceptions. File 3, Future First Route. Choose the next dollar's job before it arrives. Protect the reserve your household needs. Verify the real debt terms. Open the actual workplace plan documents. Assign released payments before payoff. Do not copy Jason and Karen's dollar amounts. Do not assume joint accounts are always better. Copy the operating logic, shared visibility, agreed rules, verified documents, and automatic routing. The household coordination tax survives when 2 people must reconstruct the entire financial system. Every time money moves, it loses power when the household can see the same map, use the same decision lanes, and give the future a vote before the month begins. The next invisible tax begins when a household finally builds a surplus, but success adds subscriptions, services, upgrades, and obligations faster than income can protect the future.